The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
It's Monday morning, everybody. Welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho, and these are your headlines. Beijing courting global CEOs at its annual China Development Forum as the Premier Li Qiang stresses the country is open for business. We're going to cross live to Beijing to speak to the Fortescue Executive Chair. That's Andrew Forrest. We'll do that in around about 30 minutes' time. The Trump administration reportedly narrowing the focus of its next round of tariffs as President Trump flags flexibility in his plan for reciprocal levies.
Canadian Prime Minister Mark Carney fires the starting gun, calling a snap election next month as the Liberals look to capitalise on growing anti-Trump sentiment.
We are facing the most significant crisis of our lifetimes because of President Trump's unjustified trade actions and his threats to our sovereignty.
UK Chancellor Rachel Reeves announces plans to cut 10,000 government jobs as she looks to tackle a reported fiscal shortfall and growth downgrade in Wednesday's spring statement.
Very good morning to you. How are you?
Yeah, well, thank you.
Good. It's great to be back after my long weekend. It felt worse than being at work, I can assure you. But look, there's so much in our headlines as well. I just want to say one thing as well. The second headline I read this morning was about Mr. Trump and reportedly narrows the focus of its next round of tariffs as Trump flags flexibility in his plan for reciprocal levies. I mean, this is just creating utter chaos for the world. If April the 2nd is a key day, Liberation Day, as I think certain parts of the Republican establishment and MAGA Day calls it as well, whereas elsewhere it's just National Tariff Day or whatever. But how on earth are people supposed to plan if they haven't got a Scooby-Doo, that's a technical term by the way, they haven't got a clue what on earth Trump is going to do? Bring the tariffs in, don't bring the tariffs in. But this flexibility oscillation makes it absolutely impossible for global businessmen and women, global women and men who are making investment decisions to know how to make those investment decisions. And I'll just bring up one story I read in the Financial Times this morning as well. It was Deal Logic being quoted, and we'll do this later in the week. We've got a great M&A guest coming up from one of the big IBs later in the week as well. The M&A activity, which was supposed to surge in the first quarter globally on the back of Trump, what do we think it's done? Yeah, it's slid. What, to a few month lows? Decade lows. So these are the very men and women who were kissing the ring at the inauguration, who are supposed to be leading the foray into global M&A, and they're not doing the deals. This is fact. They're not doing those deals. Some are being done. There are some great deals being done. But most deals aren't, because people don't know whether they're coming or going on tariffs.
Well, if you want another technical term, I was reading in on the trade tariffs, and I just thought it was gobbledygook. So yeah. I couldn't make a head nor tail of it either, because you've got certain industry-specific tariffs, and then they're going to be admitted from some of them. They're going to be specific ones for other industries. Some countries are in the firing line. I think my takeaway is that you're one of 15 countries that the US is going to take aim at. Then you should be concerned, because there was a labeling of a certain dozen plus countries about their trade terms with the United States. For me, the main takeaway is those countries could be under pressure. That is perhaps where you don't want to be positioned over the next week or so.
If the aim was to sow chaos amongst your trading enemies rather than trading partners, then congratulations. That is exactly what's happened. In the meantime, the Chinese Vice Premier held talks over the weekend with several global CEOs on the sidelines of the China Development Forum. This as Beijing looks to assure firms and investors that it is open for business despite the prospect of the aforementioned looming tariffs. Well, someone who knows vast amounts of what's going on both sides of the Pacific, and I'm delighted because I haven't spoken to her for years. It's Eunice who joins us now from the forum as well. Eunice, I guess the Chinese leadership is really, really desperate to seize the moment of the chaos on the other side of the Pacific.
Yeah, absolutely. The Chinese leaders here have been ramping up their charm offensive. They've been trying to draw a contrast between the U.S. and China, saying that China is the one that's open for business, that it's a country that embraces openness of markets and investments. Of course, that's all coming as the controls have been tightening on information and open conversation, including here at this forum. But the premier on Sunday had talked up a lot of reasons to invest. So he highlighted that China had recent consumption initiatives. He reiterated the vows to open more sectors to foreign investors. While at the same time, though, he did appear to make an oblique reference to President Trump's tariffs and the brewing trade war. This is what he had to say.
We may have unexpected shocks, mainly from external factors. When necessary, the Chinese government will introduce new incremental policies to ensure the smooth operation of the Chinese economy.
In terms of some of the big names and industries of Titan, Apple's Tim Cook was here, the CEOs of Qualcomm, Estee Lauder, Pfizer, Corning. These are big American names. But what's interesting is that despite the pretty sizable U.S. presence, they really were not dominating the panels, the public discussions. In fact, the Western participation was largely dominated by the European companies, such as Mercedes, BMW, as well as Novartis. Now, publicly, as I said, there's been limited conversation on President Trump's tariffs, surprisingly, you'd think, with this type of major conference. But privately, there's no shortage of executives that are worried about what these tariffs are going to do, especially those reciprocal tariffs that are supposed to come into play on April 2nd. Guys?
Eunice, it's Karen jumping in, also taking the opportunity to chat to you again for the first time in years. Eunice, I want to ask you about the mood music because it's been incredible, even with this storm cloud of tariffs coming towards the mainland market. There's been this homegrown tech story, and that started with DeepSeek, rolled onto Alibaba, and then BYD in recent days as well. The technology innovations that China is now broadcasting to the world, I'm not surprised. There are a ton of CEOs internationally desperate to find out whether they can do business with the Chinese. Talk to us about how that is compensating for some of the other headwinds.
You know, it's definitely compensating. In fact, here, AI was a huge topic. The Chinese are feeling really good after the success of DeepSeek. That was internationally recognized. So this was kind of the injection of confidence that China really needed. People, as you all know, over the past couple of years have been feeling quite gloomy about the economy, about the prospects of technology. But now it looks as though that's turning around, at least some of the sentiment. This is after President Xi Jinping has signaled that he was going to include more private investment, especially with technology, that was going to take much more of a priority. And so people are feeling quite good right now, though, of course, cautious because the economy is still struggling.
Eunice, lovely to see you. Thank you very much indeed for joining us and your excellent coverage as ever. It's lovely to get a taste of Eunice Yung yet again, who as I say, we've always enjoyed your crosses. Thank you very much. We'll be crossing back to Beijing actually in around about 22 minutes time for an interview with the Fortescue Executive Chair Andrew Forrest. That one coming up at 6:30 GMT. In the meantime, the White House, here we go, is reportedly narrowing the set of reciprocal tariffs due to take effect on April 2nd. Bloomberg and the Wall Street Journal are reporting that Mr. Trump and his administration is looking to pivot away from sector-specific duties to instead focus on those countries with the widest trade imbalance with the US. Such a move could spare strategic sectors like autos, chips and hang on a second, autos. I can't move for administration officials and MAGA aficionados telling us how we don't buy Dodge Rams in Europe or we don't buy Cybertrucks. By the way, they're not legal in UK. So, you know, how we should be buying American cars. And yet now they're looking to spare strategic sectors like autos, chips and pharmaceuticals from blanket tariffs.
They're coming in and across borders multiple times when it comes to autos. And there was a very clear message.
The parts can cross 7 times,
exactly,
apparently.
Or multiple, that if Mexico and Canada were caught up, that this would have consequences domestically. So we're talking about fallout at home, would you believe, from tariffs?
Yeah. Did you see the Howard Lutnick comments last week? I thought that was, in the world of extraordinary stuff, I thought that was the most extraordinary stuff. This is Lutnick going on Fox News, the Commerce Secretary, saying, buy Tesla, you're never going to get these shares cheaper again. I mean, there's a whole, I'm not saying, I was bemused by it. Like, we now got administration officials punting stocks for telling of the viewers of Fox News.
Team MAGA? Is it like Team China back in the day where officials domestically pump up Chinese
how the
stocks?
bosses at Ford or GM or Stellantis, some of the great US automakers, feel about them picking which stocks to choose?
And let's take a look at US markets in that context, because we did see some cover coming back into beaten up areas of the market in that Friday session. Look at the major boards across the indices. You could see green, but very slim ranges across the trading week, though. That is where it was interesting. We did actually march higher, and led by the Dow, tracking up by about 1.2% versus the Nasdaq, holding on to a very slim gain of less than 0.2% for the trading week. But how far we've come off the highs now, about 12% for the Nasdaq, still from the record highs, about 7% roughly in the range for the Dow. To Treasuries, and this is how we're perched as we get into the trading week. We're sitting at just shy of 4% again at the 2-year, the 10-year, we're just over 4.25%. To the dollar, and we've seen a little bit of a recovery trade take place on the trade around tariffs and the potential for some impact. And as a result, morning session, we do still have euro sterling trying to make some ground up, and we're 108 though 31. Don't forget we're 109 on that trade euro dollar last week, so trying to claw back some territory. Sterling tracking off the 129.25. Dollar yen, we've been watching that market very closely after the Japanese were pointing out some of the trade wins that have been materializing for its economy, and again very weak factory orders today. So what we're seeing there, dollar is on the front foot versus the Japanese currency. WTI, Brent, gold, the commodity trades, this is how they're holding up morning session, in the red for all of those three. And you can see pulling back around the 72 handle on Brent this morning. Gold prices also just drifting morning session, but still looking somewhat comfortable above 3,000. And quickly to the Asian markets, how they're traveling as they kick off the trading week. We've got a very flat market on Japan today. Tokyo stocks barely budging. Hong Kong, China and South Korea giving back some territory.
US equities closed higher on Friday, but the Nasdaq Composite is still solidly in correction territory, down more than 11% from its all-time high. Ron William is CIO and tactical strategist at RW Advisory. Ron, thank you very much indeed for joining us. Your notes say this was the fastest correction since COVID as well. Speed kills, warning of behavioural inflection point. Are we going to rally from this point?
Yes, more than likely. The question is, though, will it be a buy on the dip or a dead cat bounce? And certainly we do see an oversold market that does suggest upside ahead, but maybe not to all-time highs. It could be led by high beta quality stocks, those that got hit hard on the downside now bouncing back. But essentially we should be looking for potential downside risks ahead.
Let me ask your question back at you. You said, yes, we're going to rally from here, maybe not to all-time highs, but could it be a dead cat bounce? So is it a dead cat bounce or not?
The evidence is suggesting that it will likely be. We have to wait for the market to play out, but certainly the speed of the move is the first clue that this could be an echo of things to follow, along with the actual sector rotations, the concentration risk that remains, but ultimately how the market proves out whether or not it can push back higher, back above the long-term 200-day moving average, which most of the major indices have broken below. So that's probably the best line in the sand for us to watch.
You've highlighted speed there a couple of times, and as I look at the chart, I can see that speed as well. I was looking at this last week, and I think it was quite extraordinary. The speed, though, could be accounted for the fact that everybody was in the market and everybody was in US equities. And when you move to one side of the boat, as soon as anyone's spooked, then they start to rush in the opposite direction. We've seen that, and we've seen another narrative around European stocks as well. But we were told Friday that, look, we may have seen a little bit of excess get into that European trade, when the reality is it's going to take a while for some of the European initiatives to be delivered. And you can even see that on the foreign exchange trade over the weekend. So could the speed be explained by the positioning argument? So is it anything to worry about at this stage?
Well, certainly at such overbought extremes, record gains year on year, that unwind is healthy. And that does explain what we've seen. Its speed also, along with the market kind of daily volatility, which is rare and usually seen at market tops. What makes me a little bit more concern about the downside is both the momentum extension, the rotation fragility, but then also the actual bearish timing confluence that we're seeing on our timing models. And that suggests further downside risks ahead, but of course we still have to wait for the market to prove out. On the outflow side, I do want to make the point that there has been an outflow rotation into Europe and China in particular, especially China tech, but actually it's been cross-asset evidence. So we're actually seeing more into gold, treasuries, and potential other safe haven moves.
Some safe haven breadth. Ron, you've got another chart for us, and you call it Election Playbook, a tale of two stories. We could almost just rebrand this Tesla as well. So just get into what we saw in terms of positioning around the election, and then of course what has come next.
So this is building on the thesis at RWA of a two-stage pattern: buy the rumor, sell the fact, in terms of election result itself, which was mostly expected, but then more importantly, the inauguration day, where typically the unwind happens both in terms of profit taking from a very extreme bull market, but also the well-known 100-day policy test, which this year more than any other election has been a stress test of sorts. Now, the update to this chart is showing that we had a massive deviation to the downside in what is normal in an election year, but also that there are two paths ahead. One of an incumbent leadership versus first-termers. Now Trump serves as a hybrid of the two, being a previous incumbent, new challenger. And typically the difference in the two in terms of market impact is confidence. But as we can see with some of the economic growth concerns, more specifically tariff uncertainty, and then this rapid fire that Steve was just talking about at the start of the show, is clearly on investor minds, and creating that uncertainty is creating market volatility, and it's a difficult environment for people to make decisions.
Tell us about this next one. Tell us what you're signaling here. FSC timing model signals major peak.
Yes, so essentially the top is in. On a long-term basis, based upon our probabilistic timing models.
That chart looks really bearish.
It does, in the sense that it's pointing down, but not a straight line. It is a.
Well, it looks like it's falling 30-odd% from where we are down to the bottom, 6,000 to 4,000.
So process, not overnight event. The downside drawdown is typically 30%, and I think there's even a view out in the market, literally a lone view for that in the official figures, and the market's typically looking for further gains in that linear extrapolation. But this is suggesting non-consensus downside risk ahead over the next 2 years for that move. On the S&P 500, that would be much further down, but we still need to wait for the confirmation on this latest correction.
What happens next, I think, is the essential for the audience. You say fear beats greed in volatile cycles, and you also mentioned the barbell strategy being prudent. One of my old favorites, because we used to speak about it all the time, the barbell strategy. When the market was concerned, they used to see some upside around some of the cycles. Of course, that was the FANG plus stocks in the last decade or so, where investors were positioned around those, but then took a lot of protection elsewhere. So just explain what you see and what's the prudent strategy from here.
Essentially, risk management trumps, and what the chart shows is that equity performance curve in different stages of the cycle, X 10 worst days, i.e. when we avoid the worst, and the bottom chart showing when we miss out the best. The difference in the two is that typically if we're managing risk but also looking for selective trades, especially when the market becomes bifurcated, that tends to win out during late stage cycle. Of course, we need to do a combination of the two, which is why I suggest the barbell strategy. One part of that is, yes, hedging downside risk, but also looking for rotation opportunities. They tend to be more selective, more dispersed, and likely into cross-asset opportunities like commodities. A chart which I can say for another time is the commodity equity market ratio, which is still super oversold, looking like we're going to get a snapback in the opposite direction. Gold is clearly leading, and we have other commodity plays like energy and agriculture that could also surprise on the upside.
There are a lot of old-fashioned trades that have come back into the mix to me in recent weeks as people have been reaching for safety, really getting away from just Mag 7 stocks and trying to stretch out those bets. But there is a huge technology innovation coming called AI, and we've seen that some of that optimism has been expressed through other stocks recently, and mostly in the Chinese market. But could it be extended to the US market more broadly away from just 7 stocks? Could that actually be the catalyst for some more bullish behaviour versus the bearish pattern that you're talking about?
Well, certainly that would be the bullish case in the sense that, I mean, growth concerns get alleviated and numbers are still firm, but more specifically that there is further lifeblood in the market where there's healthy rotation ahead. And so that would be kind of easing off the pressure from the MAG stocks onto other sectors. The concern there is that we do have major breakdowns on the key indices already, including some where we would expect some leadership rotation. And so until that gets alleviated back above the long-term trend average, this is not just S&P 500, it's tech, it's Main Street, Russell 2000, it's also across the world if we look at the UK and Europe and other places. So if and once we get that bounce back recovery above the long-term trend average and it sustains, then that would be healthy. Otherwise, certainly we do need to look at that risk in a healthy way, but also in a way that can be best for the portfolio.
Okay. We're standing here with bated breath for that email from you about the turn and the change in the cycle. Thank you very much for joining us today. Ron William with us, the CIO and Tactical Strategist, RW Advisory. Coming up on the show, US and Russian officials are set to meet in Saudi Arabia today. Dan will join us with the latest on Trump's push for peace next. Plus, Canadian Prime Minister Mark Carney calls a snap election as he seeks to fend off the US. We'll bring you the full story later this hour. And don't miss our exclusive interview with AstraZeneca CEO Pascal Soriot as the pharma giant announces fresh investment in China. That's coming up at 6:40 GMT.
Welcome back. Officials from the US and Ukraine held further talks in Saudi Arabia, which Ukraine's defense minister called productive and focused. The meeting came ahead of expected talks between the US and Russian officials today. Dan joins us now. Dan, the Russian demands have been called maximalist, which is quite an interesting word as well, i.e. not detracting from their previous demands as well. How do we get the Russians off the maximalist aims? And dare I say it, the Ukrainians away from their aims as well. We still have a lot of ground between the two.
Indeed, Steve, and I would say the gap is still wider than it is narrow at this point as we come into what is another round of shuttle diplomacy in Saudi Arabia. Of course, Ukrainian and US delegations met on Sunday in the kingdom to discuss protecting energy facilities and critical infrastructure as well, all part of this really broad diplomatic effort being led by the Americans to try and end the war in Ukraine. And of course, these talks come ahead of the US-Russia discussions, of course, taking place separately, which are on track to happen today. In the lead into this, we saw the US Special Envoy Steve Witkoff really expressing some optimism, but I also think it's fair to say that hopes of any kind of real breakthrough in the coming hours and days is still very low at this point. Witkoff told Fox News on Sunday that he believes President Putin wants peace and also hinted at possible progress towards a Black Sea maritime ceasefire. But of course, all of that remains to be seen. And then at the same time, you also have Ukraine's President Volodymyr Zelensky calling these talks constructive. But as you say, the gap is pretty wide at this point, and exactly how the Americans are going to be able to bridge this remains to be seen at this point. He said that peace requires direct action from Moscow, and you really get the sense that President Putin perhaps isn't quite there yet, certainly not indicating that he's ready for a ceasefire, at least for now. The president of Ukraine also saying that these talks remain largely technical, so also dismissing any kind of prospects of a breakthrough, at least in the short term.
Dan, in the meantime, let me just bring you up to speed on the audience front, and I'll get some thoughts on this. Dan, Ekrem İmamoğlu, the main political rival of the Turkish President Erdogan, was formally jailed on Sunday ahead of a trial on corruption charges, adding to tension and triggering renewed protests, which have rocked the country since his detention on Wednesday. Dan, just give us a sense of how this one's going to play out, given we're seeing fairly specific images on the ground there.
Indeed, and extraordinary images coming out of major cities in Turkey at the weekend. Just look at the scale of people that were on the ground protesting against what's unfolding here. And of course, from a financial market perspective as well, on Sunday we saw Turkey's Capital Markets Board actually banning short selling on the Istanbul bourse and also making some policy moves here, cutting share buyback laws and equity ratio requirements as well, basically trying to firm up a market that has been in free fall since the detention and jailing of Erdogan's top political rival on the ground. At the same time, the currency also being very closely watched here. We saw Turkey's lira hitting a record low of 42 against the US dollar. Again, policymakers also stepping in to try and stem the slide here, and reports say as much as $12 billion has come out of reserves to try and prop up the currency. Of course, 12 billion also being, I would say, quite a conservative estimate at this point. Now, it has worked. We've seen stabilization in the lira from 42 now to 37. But of course, what happens next here remains to be seen. At the same time, the central bank also making an emergency move last week to lift Turkey's overnight lending rate. And of course, today, we're also going to be tracking risk assets here, which have just come through the worst weekly drop since October of 2008. So clearly a lot of financial market volatility off the back of this major political crisis on the ground in Turkey. And as you see here, thousands of people are also taking to the streets after the arrest of İmamoğlu. He was formally charged with corruption and was also detained. And these protests that we've seen on the ground are the largest in Turkey in over a decade, and also come as we see İmamoğlu being expected to announce his candidacy for the 2028 presidential election. His party has also named him as candidate for that election. But of course, whether or not he has any recourse here is a real question on the ground, just given Erdogan's increasing control over not just the country's media, which has also been throttled off the back of this, and the country's judiciary as well. It is really uncertain as to whether or not he is going to be able to find a way forward here and what Erdogan's next political move may be. So of course, global investors watching this really closely, given we've seen 2 years of reform under the finance minister Mehmet Şimşek trying to firm up foreign investment and improve investor confidence in the Turkey growth narrative, all of that really being put to the test at this point as well.
Superb coverage. Thank you very much indeed on both subjects.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.